short-term basis and have no pensions or social benefits. You're listening to the news on RTHK.
The big banks.
The impossible takes 2 days and miracles take 3.
Where you've got so many different departments and divisions.
Shaping investors' expectations.
Money for nothing.
Good morning and welcome to Money for Nothing with me, Renita Malhotra Hora. U.S. stocks reached records while treasuries slipped and the dollar rallied. Baidu and Tencent joined rival camps bidding for a Nokia Maps unit that could fetch as much as $4 billion. And China's property prices look like they could be stabilizing. Prices fell in 47 Chinese cities in April. What can we expect going forth? More on that this morning with BOCOM's Hao Hong. That's before we speak with China Market Research Group's Ben Cavender on Alibaba's latest lawsuit filed at the hands of luxury goods company Kering. And last, we have Pinsent Mason's Kate Terry on China's status update as the biggest crude oil importer in the world. Michael Every, Rabobank's head of research, is our guest host this morning. Good morning, Michael.
Morning.
Welcome to Money for Nothing.
Thank you very much.
So, Baidu and Tencent are both bidding for Nokia Maps. Who do you think wins?
Oh, I wouldn't like to say. We'll have to wait and see.
All right. Well, Wall Street stocks rose to new record highs on hopes that the Fed will actually hold off on raising U.S. interest rates, while the dollar rallied and Greek bond yields jumped on worries that Athens will not be able to make its debt payments. Weak economic data and a rise in Apple shares took the Dow and the S&P 500 indices to new closing highs of 18,298 and 2,129, respectively. The Nasdaq finished over 0.5% lower at 5,078. JP Morgan Private Bank's Stephen Parker says that when it comes to bonds, even though rates overshot a little recently, the direction over the next 6 to 12 months or so is probably higher at a gradual pace.
We think that's a good thing. We think it's indicative of markets beginning to accept the fact that we are getting back to a more normal growth environment after the really weak start to what we've seen in the U.S., that things are going to get better in the second half. And we think that's why rates are going to rise. You think about where we are globally versus where we were a year ago. Things in Europe are a lot better. We're starting to see China push on the pedal in terms of stimulus a little bit. We're seeing signs of picking up in places like emerging markets slowly. But when you think about a more global recovery rather than one that was more focused in the U.S., I think that points to a gradually improving economy. And the Fed is staying pretty accommodative. We think they probably hike once later on in the year, but global stimulus is still very much key to what's going on in markets and with growth.
So he sounds fairly optimistic. What do you think, Michael?
We still think that the U.S. probably delivers the best overall.
Hello? So,
yeah,
yes,
Mike, go ahead.
I disagree with everything apart from the fact that global stimulus is still here to stay.
Okay, so you think global stimulus is here to stay, but nothing else is looking good in your books. Why not? Tell us.
Well, basically, there are 4 engines of the global economy, which the previous speaker was trying to address. In the U.S., all the data we've seen over the past couple of months have been weaker and more disappointing. All the forward-looking indicators also are turning downwards now. And we actually had a speech from one member of the Federal Reserve yesterday saying he didn't expect inflation to get back to its target until 2018, which is not very positive when we've had nearly 10 years of mega stimulus. And at the same time, Europe, yes, you have to admit things are looking a little bit better there. But that's largely because of the fact that oil prices have come down very sharply, which is nothing to do with Europe itself, and because the euro itself has tumbled very, very sharply, which is actually hurting other economies like America. So Europe's gain is America's loss, and we are seeing that in the data. And looking at Asia, China, yes, maybe there's more stimulus coming, but that's a reflection of weakness and the fact that the economy continues to slow. That's a message I've been banging out for a year and a half continuously, and it's finally sinking in, I think. And Japan, meanwhile, basically is just circling around the plug hole as it has been for the past 20 years.
All right. Well, it's interesting because if you ask the question as to where the investor should look to and how, Stephen Parker is actually betting on Japan.
We still think that the U.S. probably delivers the best overall growth in terms of the broad economy. But one place where we're finding a lot of interesting value is actually in Japan. Japan is a trade that started out more as a policy trade. We saw a weaker currency. We saw the Bank of Japan getting really aggressive, and that's what drove the first part of the trade. What we're seeing now is a big change in the corporate sector. Companies, for the first time in a really long time, are focusing on improving profitability, focusing on improving return on equity. Earnings growth is the best in the world right now. And in Japan, we're starting to see the initial signs of share buybacks, of increasing dividends, and a big focus on shareholder return.
All right, Michael, I can see you grinning there. Please share your thoughts.
Well, I agree completely about the weaker currency. That's what's been driving it almost entirely in Japan. And in the near term, I think you can be optimistic about buying shares buying a market where companies are starting to buy back their own shares. But I'm a bit of a fundamentalist in terms of my long-run view, and I think companies should be spending their cash and actually investing in their operations. I think any company that starts buying back its own shares has got too much cash on its hands.
All right. Well, China's property prices look like they're stabilizing. Prices fell in 47 cities in April. Bloomberg's Stephen Engel says that we want to look at the month-over-month numbers, which tell us about the recovery rather than the year-over-year numbers.
Year-over-year numbers are still continuing to fall because of the base effect, but the month-over-month, we're seeing the decrease in the number of cities that saw home prices fall in April down to 47 cities out of the 70 cities tracked. In March, it was 49 cities, and we're year-over-year again, 69 cities out of the 70 saw price declines. In March, we saw 12 cities increase their prices, and that's quite considerable because it had been only two the month before, 2 the month before that, 1 before that. It went to 12 in March. Now we're getting 18 cities. These are new home prices, ex-affordable housing in the month of April, up in 18 cities month over month. Basically, what we're seeing is the 3 interest rate cuts that we've seen since November, also the relaxation of the mortgage rules, and a number of unwinding, if you will, of the property curbs in China is trickling into the property market and seeing perhaps a floor creating. Mizuho Securities analyst Alan Jin, Rich, saying home prices are almost at the bottom, and the April numbers that we're getting so far at least indicate month over month that there is a recovery underway.
So Frederick Newman is an economist at HSBC, and he says that things are getting better, but we still have a ways to go.
All the big first-tier cities doing a little bit better, but the problem is still third- and fourth-tier cities. That's where the real weakness lies. And we're likely to see a bit more improvement in the coming months. But make no mistake, this is a very gradual stabilization at best. We see some house prices increase in Shenzhen, but in other places they're still falling.
So let's bring in our next guest of the morning, Hao Hong, who is a managing director and chief strategist at BOCOM International Holdings. Good morning, Hao Hong.
Morning.
So, we've seen some property curbs earlier in the year, cutting interest rates to kindle sales. Were these just false starts, would you say?
I'll probably look at property investment in details. If you look at the year-on-year property investment, we are down 15%. Property investment is a more important leading indicator than inventory sales. So what we're doing in China right now is we are liquidating inventory at a better price. And also we are only seeing recovery in the first-tier city. I think third, fourth-tier cities, they're probably not going to get any better anytime soon.
And why is that?
Because they just have too much inventory. For example, in Xi'an, one of the major city in western China, they have 48 months worth of inventory to clear. In many, you're seeing a very similar phenomenon in many other second, third, and fourth-tier cities. So it would take a long time for them to clear up the inventories. And so I think a better leading indicator to look at is the property investment, which is still down substantially year on year.
Now, is this impacted by the overall weakness in China, the slowdown, and the fact that there isn't any economic activity that is filling all of that inventory in those cities?
I would say a couple of factors that contributed to this. Firstly, we way overbuilt in the past few years. And secondly, if you look at the Chinese home ownership, it's about 80%, probably 85%. So it's one of the highest home ownership in the world. So for me, it's quite difficult to see how Chinese families would buy even more houses going forward, because, most of the people would have a house of their own by now.
So what is the answer then? Is there one?
There isn't an easy answer. I think we're trying as hard as possible to get rid of inventory, but then at the same time, we are not seeing real estate investments picking up, and that is dragging down economic growth and also dragging down investment growth as well. And that is why we're seeing economic growth continue to trend down, and loan growth, by the way, in the most recent months' data, isn't looking very pretty. So it is a very drawn-out process, and I think, for the lower-tier cities, they're not going to get any better.
Michael, your thoughts?
Well, I think that's an excellent analysis, and I agree. It's a long-run structural problem, and I think we do hear some rather, overexcited commentary from others in the market talking about the month-on-month bounce that we saw in some particular cities. But this is a story that's going to run, and it's going to continue to depress overall growth rates. That doesn't mean that there aren't good news stories out there in the Chinese economy and other areas. There absolutely are. But it can't rely on this particular engine to drive high levels of growth going forward as it has done in the past.
So how, if you look at the overall economic data, across the globe, we've just talked about China, but, you look at the U.S. with industrial production, retail sales, doesn't look that much like there's that much more excitement. And Europe, as we said, has shown some green shoots earlier, but could those fizzle? What do you think about the picture globally?
Well, I still find it very concerning, to be honest. My argument hasn't actually changed on an underlying basis for around 10 years, which makes me sound like a stopped clock. But basically, from a structural perspective, we're suffering from a deficit of demand for a number of various complicated economic and political factors. And we've covered those up with borrowing continuously in various different countries, and we've now maxed out on borrowing in many of these countries, and we're now reliant on pushing down the value of our currencies to try and steal market share from other countries, which is what Europe's doing now with a weaker euro. And temporarily, as I said, the seesaw goes up for Europe and it goes down for the US. But globally, overall, we're not doing any better from that. And really, we have to tackle this underlying problem, and we're nowhere near doing that.
What do you think? Do you think we could see a pickup, certainly in the US, in the second half of the year?
Probably going to be a little better than the first half, but I'm not a researcher focusing on the U.S. economy probably, so I don't have absolute authority over this topic. But then having said all that, we're seeing exports from China is actually slowly picking up. Probably because, we're making things a little cheaper, and also, external environment, external countries are seeing a little bit of demand pick up because, monetary easing, et cetera, So we're actually seeing some improvement in Chinese exports, and that tend to be a global leading indicator for economic growth. So I would say, we're probably going into a better environment in the second half of the year. But then having said all that, we're just talking about small improvement from a bad situation to a less bad situation.
Right. What about the dollar strength story? Does that help China at all?
It helps in a way that we can have an excuse to cheapen our currency. A cheaper currency helps big time. For example, we see a small recovery in Japan. We're seeing European growth is picking up. So I would say that, for China as an exporting country, export is still a very important driver of Chinese growth. And especially now, investment growth is slowing down. So a cheaper Chinese yuan is actually helping the Chinese economy to recover. So it is not necessarily a bad news if the US dollar strengthens from here.
Okay, so cheaper Chinese yuan actually helps. What else, if we had a wish list, what else, could the rest of the world do? What's the one thing that they could do to help China?
A lot of the issues that we're facing is domestic driven, especially the housing inventory situation that we're facing right now is because we way overbuilt in the past few years, and there's very little things we can do. And in fact, many of the rich Chinese people, they are exporting their capital to overseas countries and buying properties out there. And that is why we're seeing a very strong growth in Australian property price and also the US property price as well. And at the same time, not that many people are buying more properties in China. So I wouldn't say there is a lot to do from an external environment point of view to help China to recover its growth to its former glory. But having said all that, we can export some of our excess capacity to foreign countries, and if they can buy more with a cheaper Chinese yuan.
Export is the way. All right. Thank you so much for joining us this morning. That is Hao Hong. He is a managing director and chief strategist at BOCOM International. A quick look at the numbers now. The Nikkei is up 0.5% to 19,984. Australia's ASX 200 is up 0.05% to 5,662, and Seoul's Kospi up 0.04% to 2,114. In currencies, €1 is currently valued at $1.13. The US dollar will buy you 119.93 yen, and £1 buys you 12 Hong Kong dollars and 14 cents. Well, Alibaba is facing a lawsuit from Kering, a Paris-based luxury brands conglomerate that owns YSL, Gucci, and Balenciaga. Kering says that Alibaba has profited from the goods that infringe on its brands, and it has alleged that the e-commerce company uses algorithms that help customers find knockoffs. Let's bring in China Market Research Group's principal, Ben Cavender. He joins us on the phone now from Shanghai. Good morning, Ben.
Good morning.
So, Ben, does this claim have any legs at all?
I think it does. This is something that a lot of brands have sort of been discussing with Alibaba over the years. Previously, it's been very difficult for them to get somewhere because the company wasn't listed publicly in the U.S. Now that it is, I wouldn't be surprised to see them pushing a little bit harder against Alibaba to sort of clean up some of the counterfeit issues it has.
But Alibaba, has claimed that it has in fact been trying to cut counterfeiting from its sites. I mean, last year it punished something like 40,000 sellers, in its aim to cut down on the sale of fake products.
Yeah, I think it would be hard to argue that Alibaba hasn't done anything to try and make the issue better, but with something like 8 million small sellers on the site, it's pretty easy for counterfeit goods to get up into the sales process right now. I think the issue at hand is sort of how Alibaba manages some of its search phrases and what it does to sort of crack down on those. And right now, it's still very easy to actually put in a search for a fake product and get results. So I think Kering is arguing that they could easily do more than they have done to clean up the site a little bit.
Now, eBay has been allowing sellers for years to sell counterfeit brand products, and though people, might argue that once a case is reported on eBay, action would be taken. But the marketplace, is so vast that even, with the human resources of, e-commerce like that, it's kind of difficult to actually crack down. So wouldn't it be even more so challenging for Alibaba?
It is challenging. I don't think it'll be easy for them to do, but they definitely do have the resources in place to probably make a little bit more of an effort than they have, to the extent that even in China you're hearing, the SCIC sort of complaining that they haven't really done enough to get rid of fake goods. I think in the near term, you're going to see a lot of those products continuing to exist on the site, but from a credibility standpoint, I think Alibaba is probably going to have to do more than they have going forward just to maintain their own brand reputation.
So what can they do? Change their business model?
I think part of it's going to be just kind of refining the algorithms and controlling the search terms that are permissible as far as what people are putting in to search for products, reducing the number of terms that sound similar to, say, some of the luxury brands that are out there. So I think that's part of it. I think maybe having a more robust reporting system for small sellers to get people that are selling substandard products off the site. But I think realistically, the business model probably is going to change. What we're going to see is more of a reliance on platforms like Tmall, which are operating brand-owned stores, or maybe helping to bring back official goods from outside of China into China. So you may see Taobao over time sort of losing some of its significance for the site.
And do you think that Alibaba, Taobao could actually face more lawsuits? sort of in the days to come?
Yeah, I mean, I think we'll have to see what happens with Kering here. You know, if they make any headway with the lawsuit that they filed in New York. If they don't get anywhere, you may see other brands maybe kind of holding off because they don't want to go through the legal costs of trying to do something. But I think you're going to see probably more complaints going forward. Certainly now that Alibaba is more international, that they're trying to reach out to more consumers, not just in China but overseas, the brands are going to start taking counterfeiting issues, I think, more seriously than they have in the past when it was just China.
All right, Ben, thank you so much for joining us this morning. That is Ben Cavender. He is a principal at China Market Research Group based in Shanghai.
The Electoral Affairs Commission has published the proposed guidelines on election-related activities in respect of the District Council election for public consultation. You can send a written submission by June 3rd or share your views at a public forum on May 19th. The proposed guidelines are available at the Commission's website www.eac.gov.hk, the Registration and Electoral Office and the Public Inquiry Service Centres of District Offices. For inquiries, please call 2891 1001.
The time is now 8:24 a.m. and recent news has seen China overtaking the U.S. for the first time as the biggest importer of crude oil. The Financial Times reported that in April, China had surpassed the U.S. with imports of 7.4 million barrels per day, or 200,000 more than the U.S. Let's bring in international law firm Pinsent Mason Senior Associate Kate Terry. Good morning, Kate.
Good morning.
So, Kate, what does this say about the shift in global energy demand in just these recent months?
I think it's an interesting statistic, and clearly China is a significant customer in the global oil market and has been for some time now. And there's probably some opportunistic buying of cheap oil going on at the same time. What I don't think this indicates is a long-term insatiable growth for oil in China. There's other factors going on here, and you mentioned the surpassing of the US. US is still a powerhouse in the global oil markets, and clearly the shale boom in the US in recent years has meant the US's reliance on imported oil has decreased. But with the lower oil price, some of those shale gas producers are now struggling to compete on a cost basis, so we're likely to see a rebalancing of imports in the US. And so I think this is a sign of the significance of China, that's for sure, but not necessarily a surpassing for the long term of the US market.
I see. What energy markets are most attractive, for China?
I mean, a number really, wherever it can source its oil and gas. The Middle East has for a long time been a big supplier to China. Iran has been a country that's been hamstrung by US and EU sanctions over recent years, so has been a very good supplier to the Chinese market, but we might see that coming off with potential relaxation of those sanctions from Europe and the US if a deal can be done on the nuclear piece. And obviously we've got Russia on the gas side. A big deal was signed with Russia last year, with two big deals for future gas supply, and gas is a very important element of the mix of fuel in China, and one that's going to continue to increase. I think there's a plan to double gas supply in the next 10 to 15 years, and so we'll see gas certainly taking increasing importance in the fuel mix, and therefore that deal with Russia is a crucial one for the Chinese.
Kate, there's a huge sell-off taking place in Europe right now as oil majors look to sell off their less profitable assets. Can we expect to see more acquisitions from Chinese majors?
I think not necessarily. There may be, again, the odd opportunistic purchase there to snap up a cheap asset. But what we are seeing amongst the national oil companies is actually a retrenchment of their budgets, a slashing of investment in new assets and new exploration. We've seen the same across the resources sector over recent years amongst the commodities markets, and the majors actually focusing on what they've got and reducing their spending budgets. I think there's also a sense that some of the foreign acquisitions by Chinese oil companies have not necessarily gone to plan over recent years. The acquisition of Nexen was seen as a potentially an overspend. So whilst there may be we may see one or two purchases. I think generally we'll see a cutback of investment by the major oil companies.
So we were talking about slower Chinese growth earlier in the show. Is that the reason that you suggest there won't necessarily be internal growth for oil in China?
I think whilst we may see some growth, we'll see a tailing off of that growth in the same way that we've seen in other commodities markets, in iron ore, in coal. That tailing off of growth is having an impact on those markets. And as I mentioned, the increasing influence of gas in that piece, there's a huge pressure on China to deal with its pollution problem, and there will be a big shift from coal-based power plants to a different mix of fuels. We're seeing much more impetus on the renewable side. Also, the biggest sort of consumption of oil, or one of the biggest, is the automobile market. And in China, there is a big shift towards gas-fueled and battery-powered automobiles to try and decrease its reliance on oil and try and tackle that pollution problem.
All right, Kate, thank you so much for joining us this morning on Money for Nothing. That's Kate Terry. She's a senior associate at Pinson Masons. A quick look at the numbers now before we wrap up the show. The Nikkei is up 0.4% to 19,996. Australia's ASX 200 down 0.5% to 5,634. And Seoul's Kospi also down 0.1%, to 2,111. Gold is currently valued at $1,223.60 per ounce, and Brent crude oil at $66.29 per barrel. So, Michael, here we are at the end of the show, and at the end of a Tuesday, what should we be keeping our eyes on as we step further into the week?
Well, I think the same as always. We have to try and separate signals from noise, and that's obviously something we all have to do every day of the week professionally.
Separate signals from noise. Any tips on how to do that? I know it's a wide question, but I'm throwing it out to you anyway.
Oh, I can't give away all my secrets.
Come on. All right. Thank you so much for joining us this morning. That is Michael Every. He is the head of financial markets at Rabobank. And I'm Renita Malhotra Hora, wrapping up for this morning's Money for Nothing. A quick look at the weather forecast before we turn over to the news segment. Today will be mainly cloudy with a few showers, 1 or 2 isolated thunderstorms in the morning. The temperature right now is 28 degrees Celsius and the relative humidity is 88%. Time for the news with Sam Butler.
The Indonesian military has asked local fishermen not to help any more migrants drifting in the Andaman Sea to reach land unless there's an emergency. Radio Australia's George Roberts reports.
Fishermen have helped about 1,300 people ashore in Indonesia in less than 10 days as Southeast Asia deals with a so-called migrant crisis. It's thought thousands more people fleeing poverty and persecution are trying to get from Myanmar and Bangladesh to other countries by boat. Thailand, Indonesia and Malaysia have all refused to let overloaded boats reach land. In an attempt to stop more people reaching Indonesia, the military has confirmed it's asked fishermen not to help them unless they need rescuing.
European Union foreign and defence ministers have approved plans to establish a new EU military mission to combat gangs trafficking people into Europe from Libya. It could eventually include operations to destroy smugglers' boats in Libyan territorial waters, but needs the backing of the UN Security Council. The Libyan ambassador to the United Nations, Ibrahim Dabashi, said Libya's internationally recognised government hadn't yet been consulted about the plans.
I think if they need to have any operation on the Libyan soil or on the Libyan territorial water, they have to seek the consent of the Libyan legitimate government. Certainly, any resolution by the Security Council has to be agreed upon by the Libyan government. We have never been consulted officially.
Thailand's former Prime Minister Yingluck Shinawatra is expected to appear in court today for the start of a negligence trial which could see her jailed for a decade. It's the latest legal move against her after her government